Welcome back. I'm Jeremy Szafron. Well, gold is holding steady near $33.70 an ounce, but calm is not the same as certainty. The Federal Reserve just held interest rates at 4.25% to 4.5%, citing inflation that is, quote, somewhat elevated and warning of economic uncertainty ahead. Now, the central bank still projects 2 rate cuts this year, yet Powell says that the Fed is, quote, well positioned to wait. Now, that wait and see message comes as tariffs are rising, growth is slowing, and geopolitical tensions are continuing to escalate. Powell explicitly warned this week that tariffs will, quote, push up prices and weigh on economic activity. Now, at the same time, the Fed downgraded its GDP forecast and raised its near-term inflation outlook, a rare combination that many analysts says signals rising stagflation risks. Meanwhile, President Donald Trump is escalating his attacks, and on Truth Social, he called Powell a real dummy and said that the Fed is costing America billions. He's even floated the idea of appointing himself Fed chair. Now, this war of words is playing out as Treasury yields rise, stocks remain frothy, and the bond market has been flashing warning signs. You add in oil prices, WTI is back up around $78, driven by the Middle East risk premium, and you do have a very complex, fragile macro backdrop. Now, Israel's strike inside Iran and Washington's consideration of direct military involvement are driving new fears about supply disruptions through the Strait of Hormuz. That, again, is a choke point for nearly 20% of global oil flows. And despite all of this, gold has pulled back from its $34.54 spot high. Some investors see this as a consolidation, others wondering if the rally is over. So how do we interpret the latest from the Fed, and what is the market missing? Joining me now is Mike McGlone, Senior Commodities Strategist at Bloomberg Intelligence. Mike, I know it's a day off for you down there. Thank you for making the time for us today.
Oh, it's a day off from what I enjoy what I do. And then you give me a chance to play show and tell. I write and study and research all the time. And once in a while I get to talk about it. So thanks for having me.
Well said. And it gives us a little chance to kind of keep up to the story as well. Let's start with, Powell saying that the Fed is well positioned to wait. But the new dot plot still shows 2 cuts this year while inflation is being revised up. And as we saw, Mike, growth being revised down. Isn't that stagflation by definition?
It's not an environment where, to answer your question, yes, it's not an environment where the Fed can really ease. And I really enjoyed your walk-in while Mr. Trump calling Powell dumb. If you, listen to what's happening with Powell has complete consensus on his board. No one wants to cut rates. It's not just him. And even if you put someone in new who's a lackey, he's not going to want to go down in history as an idiot. So we're just part of the end game of you raise risk assets too much, you get inflation, which you mentioned, we're getting inflation, and then you can't get those risk assets too much higher. You can't cut rates more because it creates more inflation. So we're basically at an end game. I think that's what gold's figuring out. So you mentioned gold around 3,300 an ounce, almost 3,400 an ounce actually as we speak. Yet it's up about 30% in the year. The Bloomberg Galaxy Crypto Index is down about 14%, and the dollar is down about almost 10% in some measures. So the way I see what's happening is this is a market that sees the end game for their U.S. stock market, and you can see that like the MSCI ex-U.S. index is up almost 19% in the year it's going. The Fed's done, fiscal's kind of getting shut down a little bit, and it's a great environment for gold, but everything's now dependent on that U.S. stock market has to stay elevated, which is a bit risky. You mentioned the oil issue, but as we speak, the key thing that's happening with oil is it's bumping up for risks of supply constraints, yet there hasn't been any significant supply constraints out of the Middle East since Iran attacked Saudi Arabia in 2019 and hit some of their oil facilities. But now I'll end with this. I think what's happening, I'll end there, is oil is going to just do what it normally does. This is bringing on more supply from the non-OPEC producers, maybe even OPEC more supply, the pumping prices, and it's decreasing demand, which is already heading lower. When's the last time we heard a demand estimate revision that was upward? But the snares I'd like to point out right now is what's happening in Iran right now reminds me of that quote from Hermann Goering in World War II when he says, "When I saw the P-51 Mustangs over Berlin, I knew the gig was up." Well, that's what's happening in Iran right now. Israel has obtained air superiority. They've helped lessen the ability for Iran to reach out and attack other facilities in other countries and cause disruptions. And what happened when they were invaded by Hamas in 2023 in October is akin to the Battle of Bulge. Are they going to take the opportunity to pass up and not just end this regime? And my suspicion is maybe with or without U.S. help, I'm kind of hoping we don't get involved, Israel is just going to end this regime and end this threat in Iran. And to me, that's what's happening.
Yeah, interesting. Okay, well, that was a good little overview. I mean, we're going to get a little bit more into the specifics on gold in just a second. Before we move on, I mean, some are arguing that the Fed is too focused on the supply side inflation, like tariffs, and it's underestimating, the cost of delaying cuts. Others say Powell is right to wait, given this whole stickiness. I mean, where do you land here? But more specifically, I mean, President Trump is clearly signaling he wants aggressive cuts. I mean, he called him a dummy. He says he wants to drop 200 basis points. Could that political pressure kind of derail the Fed's data-dependent approach here, too?
No, if anything, it's going to hurt U.S. risk assets, and Trump might find out the hard way. Mm-hmm. If the Fed has already learned their lesson about cutting rates too early, bond yields went up, said they were not supposed to cut more, and they kept cutting. So that's a problem. The market's telling them not to cut. Bond yields going down, that'll be a good signal. The stock market's telling them not to cut. Stock market's resilient. Yet, okay, we all know we have this very mercurial president. He can say it as much as he wants, but this is part of the discombobulation that's happening between him and Fed. He can do it all he wants, but it's going to hurt U.S. risk assets. And when the U.S. stock market starts going down because the world gives up on this independence from the Fed and the bond market maybe gives up, this is bad. And he might figure out the hard way. Hopefully he doesn't. But from a market standpoint, what this means to me is this part of the typical banter between Mr. Trump and the Powell, but it's not just Powell. It's the entire Fed board. The dot plots still show potential easing, and they pushing it back because their inflation expectations are going up. They cannot ease until they see the whites of the eyes of inflation getting below their 2% target, until they see unemployment going up, which I think is going to happen. And the number one force for all that is the U.S. stock market going down. So they don't say it, but I'll say it. I don't think they're going to ease until the stock market goes down and tells them to ease.
Yeah, I hear you on that. It's wild to watch the S&P continue, even in this geopolitical risk that's happening too. Okay, go back to gold. I mean, you mentioned it hit that 34.54. That was the spot high that we recorded, but it's since pulled back. Today, still pretty stable, though. I mean, you've said before the consolidation at higher highs is healthy. Is this just the pause before next leg up, or do you see maybe a technical or macro flag as you kind of got into there, Mike?
I think it's the pause before the next leg up, and it's got to make it difficult. 3,000 is good support, 3,500 is good resistance. By the time this hits the tape, I'll be out with my metals outlook for the second half, and I'm just nailing down what I think matters for gold. Gold below 3,000 is a wonderful thing. I think it's unlikely because it means the rest of the world's tilting over towards the U.S. stock market going up, the dollar's stronger, and the rest of the world's recovering. Gold above 3,500 is a bad thing for the rest of the world, but I think that's what's going to happen. And that indicates that what's happening now will accelerate, meaning the dollar's going down, potentially with the U.S. stock market going down, volatility going up, and the world tilting towards deflation. To me, that's the more likely scenario. The thing is, I'll say right now, is if, the expectation is you can't say gold anymore without talking about the stock market and or Bitcoin. Yeah. And so I'll point out what I think the key relationship is right now. Gold's right now priced for the stock market to potentially be down in the year. Yet the estimates are it's going to be another 10% year. So I'm sticking with gold. I think the number one pressure factor for gold will be if the stock market continues to rally, interest rates stay strong, and maybe we get a little détente in, say, most notably Middle East or Russia and Ukraine. But yeah. So this to me is part of what gold's front running. The key thing is also look at gold Bitcoin. Mm-hmm. That cross is like about 31 right now. It's 31 ounces of gold per one Bitcoin. It's been stuck at that level since 2021, and it used to have a very high correlation with the stock market beta. Yet it's telling me, I think it's telling us that it's ready to tilt lower. And I think the whole thing predicates on the minute that Bitcoin got above 100,000. That was in December 6th. That's the first end of the day that it closed above 100,000. That was the catalyst, I think, for gold to take off. Since that day, gold's up about 30%. Bitcoin's 104 at the moment, so it's basically at the same level. Yeah. The stock market's flat. So to me, what it's telling us is Bitcoin sees an end game for risk assets in the U.S. Gold sees that. Bitcoin's the peak at 100,000, I think gold's going to continue to rally, and Bitcoin's the leading indicator for everything. So I suspect it's telling us with the Bitcoin gold ratio that U.S. stock market's going to tilt lower. And if it doesn't, then gold will be one of the key things to suffer. So I'm still quite bullish gold. I think it breaks above 3,500 an ounce, but that's very disconcerting. That'd be up a third on the year. And there's only a handful of years in the last 100 years that we've been up that much. Most of them were inflation in the 70s. And there was one in 1934 when we came off the gold standard. And then around 2020, then some of the Great Recession.
I want to get your opinion on the price of Bitcoin, too. I mean, we see it sitting around 104 today, down a little bit. But we've seen these ETF outflows from gold and some traders rotating to Bitcoin near that $106,000 mark. Is this just temporary risk-on behavior? Do you think it's taken over that risk trade?
Well, the key thing that's really happened is there's still inflows into both gold ETFs and Bitcoin ETFs. The significance, I think, is in gold. Gold has had 4 years in a row of outflows in ETFs. Now this year's kicked into inflows pretty significantly, the most since 2020 so far. It's on pace to match what happened in 2020. Remember, that was the biggest money pump in history. The difference, so I think now it's happening with Bitcoin is gold is a risk-off asset, and Bitcoin is a very much risk-on asset. And the most people are buying Bitcoin are buying into the mantra that they will be protected from debasement of the U.S. dollar and inflation. Mm-hmm. They're trading the last big trade. That trade was ripe to do the last, I don't know, maybe 5-6 years, particularly in 2020 when Michael Saylor discovered Bitcoin when it was 10,000 and got way bullish. But at 100,000, we have a pile-on situation going on. I'm really concerned. And there's also unlimited competitors in that space. People say Bitcoin supply is limited. Yeah, I get it. 21 million Bitcoins, but there's 17 million cryptocurrencies. That's just silly. And you look over at gold, there's 4 precious metals: gold, silver, platinum, palladium. Silver's catching up, platinum's catching up, and they're all catching up because there's only one foul. And there's 4 of them. So I look at the whole space as cryptocurrencies led the way up. Bitcoin was the first in 2009. Now there's 17 million of them, and I think they're going to lead the way down. And I mentioned that earlier. On the year, the Bloomberg Galaxy Crypto Index is down 14%. It has a very high correlation with the stock market, despite the fact the stock market's up slightly. What happens when the stock market goes down? I think that's what's happening already. Stock market goes down, all this cryptos decline hard, and gold continues to rally. Now, if I'm wrong, that'll be a pressure factor for gold, and cryptos should lead the way up. And so far, I think this 100,000 level in Bitcoin marks the threshold akin to 5,000 in NASDAQ in 2000. And sometimes you're just supposed to be selling when they're yelling.
Yeah. Okay. Well, silver, platinum. I made notes. We got to get into that because I need to keep making notes here. But before we do, you brought up that currency debasement issue. Are we late to the trade on gold on that? Gold surged in yen, euros, pounds, Swiss francs. It even outpaced M2 growth in several cases. The mainstream still treats it kind of like a fringe asset. Is the market sleepwalking into a fiat trust crisis?
I think less so. That's one thing I like to point out about the crypto. I'll tilt over to one of the most significant, I think, indicators and forces on the planet, and that has been from cryptos and the proliferation of crypto dollars. People call them stablecoins. They're up to almost 250 million. We're hearing about Circle going public, and this whole space is on the better way to transact, transmit, and trade in dollars via tokens. Next, what's going to happen there is probably treasuries and risk assets and stocks and bonds and commodities. But that's the key thing to remember. The dollar is gaining dominance on a global basis, and cryptos are taken as a base layer. The difference I like to point out is the dollar is down this year, but if you look at the dollar, despite the stock market being up, that's a serious indication that it's time for the dollar to just give back some of its gains. So since 2009, if you take the dollar and overweigh it with the S&P 500 divided by the MSCI ex-US index, basically it's a U.S. stock market versus the rest of the world, the dollar and the U.S. stock market have been on the exact same trade syndrome. Now they're both tilting down. Certainly the U.S. stock market versus the rest of the world. And the dollar, I think that's going to continue as the world realizes, hey, I own dollars. I own some of the most expensive assets in the planet. The U.S. stock market at 2 times GDP and the highest ever versus the rest of the world is very expensive. The prudent thing to do is lighten up on those assets, and that's what's happening. I think it's going to continue to happen. Pressure the dollar, pressure U.S. stocks. And I think gold's figuring it out. So I expect gold to continue to be the best performer in that space. And it's just pulling along some of the other ones, silver and platinum.
Yeah, silver and platinum. I guess we can move into that quickly. I mean, we're going to get into oil, but silver and platinum, I mean, it's been fascinating watching silver sit here above $36. Platinum, I mean, what, 13? It's been on quite a run.
Well, we'll start with platinum. One thing, if we look at platinum technically, my colleagues in London dig into more extensively and point out it does have a bit of a supply deficit situation, so still quite bullish platinum. The key thing, as I pointed about last year about platinum, was the chart looked just like cocoa did a year ago. Remember, cocoa had just stuck in this narrow range forever. Volatility was declining, then the market broke out higher. And to me, that's what platinum looks like now. I think platinum is just a matter of time. It's obviously starting to break out. The question is how much higher it can go. 1,300 is very good resistance. It's still way cheap versus gold. The key thing I'm worried about is platinum is much more of an industrial metal. And if we do get this U.S. stock market to decline, like I'm afraid it's going to for normal correction, which is way overdue, that'll pull down all the industrial metals, and platinum is in that space, and it'll help gold to continue to outperform. But overall, I still think that whole entire space has a couple things going for them. First, they got really cheap versus gold. Beta's going up. I think it's going to continue higher. And the dollar's declining. What stops that? So I think they're still quite good to go higher. And silver just broke above significant resistance at 3,500. That silver gold ratio, when it reached 105 just like a month ago, was just a signal it's never ended the year above 100. I mean, so now we're back down around 90, silver to gold, 92 actually. And I still favor, I mean, to me, the key thing to remember, silver is known as a devil's metal for a reason. It trades 2 times the volatility. And on the year, it's up 25%. Gold's up 28%. On a 1-year basis, it's up 22%, and gold's at 44%. Yet silver has double the volatility. So on a 1-year basis, silver should be up 80%. It's just catching up. And I think that's a key thing. It's just catch up to gold. Gold's the leader. And if gold continues to lead, these other precious metals will just play a little more catch up.
Yeah, been fascinating to watch. Even Costco selling them at about $3,500 right now, some per ounce. It's just been wild to watch. Okay, that brings us kind of to the broader issue of what assets actually perform when we have this policy, monetary and fiscal, and specifically with the debt. I mean, you told us that oil was likely capped around $80 unless something drastic changed geopolitically. Oil's hovering around $78. Reports say that the White House is considering airstrikes on Iran. Is this risk premium baked in, or are the markets underpricing the threat of supply disruptions from the Strait of Hormuz? Or like you said, is OPEC just going to open up some more supply?
I think it's more the former. The market's overpricing the risk premium. That's what it's supposed to do, but it has to. And just look at the macro of this. I pointed out recently, 80 is probably the new 100. The trend is down. When's the last time you heard of demand estimate revisions that were upward for global crude oil demand? Looks like China's been flat and heading lower, 11 million barrels a day. They're just the same as 4 years ago. And then supply estimate revisions out of the U.S., Canada, Brazil, most of North America, ex-OPEC, are still heading higher. Now, they're backing up a little bit because price is back down. But right now, this little pump is an ideal opportunity to kind of extend that backwardation, sell forward, lock in some production, some levels, and then bring on that supply. It's just that crude oil right now is facing a paradigm shift in technology. We use less of it every day, rapidly advancing technology in EVs, and we create more with it every day. And I think it's going to do what's normal and not really bottom until it gets well below that U.S. cost of production, which is around $50 a barrel, and trade down around 40. That's not profound. It traded 40 low for 3 times since initially in 2008. And I think it's going back there. Now this pump is just going to accelerate that. Yeah, it could get higher. But what happens when oil pumps like this? The rest of the world's already kind of facing tariffs and shutting down, and China particularly. That China 10-year note yield at 1.64, so severe deflationary forces. And crude oil is just stuck in the middle, and this little spike is just going to accelerate. It's a short-term blip, and I think virtually every producer and responsive trader on the planet who knew crude was getting kind of cheap at 55 has just been waiting to sell it. And it's a question of if you get stopped out before it goes down.
Yeah, interesting. Okay, so a little bit too high of a risk premium. I mean, we've heard estimates of $8 to $10 on the geopolitical premium in Brent right now. I'm curious, going back to the Fed, could a hot summer, literally and politically, trigger a spike that kind of reignites inflation expectations and then forces the Fed's hand?
So a hot summer, the key thing, the number one, let's look at the 10 for the Fed.
Yeah.
It's U.S. stock market. We're at 2 times GDP. There's only 2 examples in history that were relevant, 1989 in Japan, 1929 in the U.S. Both did not work out well. So stock market's the number one factor. They might say it, but most market people get it. When the stock market went down in Q1, everything tilted lower. Yields, the Fed potentially eased, and all the expectations for pie in the sky revisions. Now that's back up where everything's following. I mean, that's what happens when you get to this level. So to me, that's the number one factor. Everything else is a 5 or lower. They have to say it, but the only way right now we have unemployment in the U.S. is still strong, and wages are increasing. That's fine. And their inflation expectations are still upward. So the key thing about a hot summer is potential demand for natural gas. Well, that's what happened last winter. We had a very much colder than normal winter, and it pumped up natural gas. It got that January natural gas future to $5 per MMBtu, and the front is around 4. So I'm more worried that we will not get that second colder than normal winter, and then the natural gas will go lower, and it'll be more deflationary.
Yeah. Mike, I got to ask you, what about debt-driven inflation? I mean, the Trump tax bill is expected to add nearly $4 trillion to the deficit, even as the Fed holds. Is that kind of a silent accelerant here?
Yeah, so the key thing, that's one thing I think one of the main things that's supporting the entire U.S. economy and the U.S. stock market is the deficit spending, 6-7% GDP. Now we've addressed that a little bit with Doge, and it's top of the headline now, which usually means it's the end of it. But the key thing also is, yes, if we do have this package and it does kick in this continue to expand the deficit without expanding GDP. That's a problem. That's showing up in bond yields. May 22nd was the peak so far this year for the U.S. 30-year at 5.15%. That's May 22nd. That's the same day Bitcoin peaked. That's a sign there's a problem. But typically, the thing to remember, people focus on deficits a lot in terms of bond yields. Now, maybe we've reached an inflection point, but my entire career, starting in the trading pits in 1988, I learned that every time people get really focused on massive U.S. deficits as a reason for bond yields to go up, is usually wrong. So I'll give you one example. Obviously, debt to GDP in Japan is over 300%, and their yields are 1% or lower. Debt to GDP in China, by some estimates, I heard one by Goldman Sachs, is around 300%. I said the 10-year notes are 1.64%. And the bottom line is, if the economy rolls over, the stock market drops a little bit. Remember, when you get to this level of GDP, the stock market is the economy. If that rolls over, we'll have severe deflationary forces. And by the way, the Fed will be buying U.S. bonds. So I look at the deficit as probably needs to be put under control. And here's the thing is, once you do put that under control, and with tariffs, where's that in for the stock market? So you won't have that deficit spending and people using that to support the economy and support the stock market. And number one thing to remember about tariffs is tariffs are a tax on U.S. importers, which by some estimates, Gina Martin Adams pointed out that 45% of S&P 500 cost of goods sold is from imports. You put a 15% tariff on that, you crush cost of good. I mean, crush earnings and profits, and you got a bit of a pre-existing trend that's already starting to accelerate. Earnings expectations were way too high at the beginning of the year, and all starting to tilt lower. So to me, that's part of that potential for just a little bit of normalization in the stock market, all related to tariffs. And if you keep ballooning the deficit, bond yields already kind of pointing out that's a problem.
Okay, interesting. Let's close with portfolio strategy. I mean, you just kind of gave it to us there. Obviously, we're not going in and buying the S&P, but what do you believe investors should be kind of overweighing right now? I mean, what's the one thing that the market's most underestimating as we head into Q3 here?
Deflation. Yeah. The market is priced and looking at, and some people, and certainly the people putting Bitcoin on their treasuries and people saying you have to buy Bitcoin because of the melting dollar, are focusing on the last big trade and the last war. And the next big trade and the next war is typically deflation follows severe inflation. And that's just the way things work out in history. Example I gave you is 1930s in U.S., 1990s in Japan. That's the thing we're on the cusp of now. You're seeing it happen in China. Like I said, 1.64. So I think the next signals for that was crude oil plunging and gold going up. Now, crude oil has bounced because of geopolitical things, but by the end of the year, I think it's going to continue that trend. That's a pretty significant signal. Gold, silver is getting to 100 is a pretty significant signal of their problem. And to me, this is where the market is going, and the next big trade will probably be what seems to be what I've been wrong on for 2 years, and that is the U.S. Treasury long bonds. And I still think gold is going to continue one of the best performers. I've really curtailed my enthusiasm for Bitcoin, and I think long bonds will be the one to catch up as we tilt over to that normal deflation. It's dependent on one thing. For us not to get this normal deflation, the U.S. stock market has to go up. It absolutely has to go up. Just picture, since 2019, it's up 100%. Biggest money pump in history. Lessons of history say it should just back off. And say if we just drop 10% this year, that's a domino tumbling for massive deflation. It's already happening in China, happening in gold silver spreads, and like 1.64% in China. To me, that's the key thing to remember, is also just giving back 10% of 100% since 2019 is nothing in the big picture, but that's how much we're elevating, how much the market's dependent now, completely, just human nature, completely dependent on risk assets to keep going up. And I think prudent people realize there's alternatives, and that's what they're doing. There's gold, and certainly out of the U.S., selling those expensive dollars and expensive stocks and buying other foreign assets has become somewhat prudent.
Interesting. Okay. Well, we'll leave it there. I saw today, President Trump's new trade regime has pushed the average effective U.S. tariff rate to about 15.8%, the highest since 36, according to Yale's Budget Lab. Deflation. Wouldn't expect that. Good to hear. I appreciate it. Thanks for this, Mike.
Thanks for having me.
All right, that's it for us today. If you got value from this conversation, make sure to hit the like button, share your thoughts in the comments, and subscribe to our channel so you don't miss our next macro deep dive. And if you want more insights from Mike McGlone and other top voices in the global strategy, check out the full archive at kitco.com and follow across social for real-time updates. Thanks for watching. I'm Jeremy Szafron. We'll see you next time.